Hello, this is Helen Thomas and the CDFM study group. Today I'm going to be covering CDFM Module 3, Competency 3, which is the accounting section of the 2020 study guide. We will begin on page 3.3.5, which is the Federal Accounting Framework. This is to let you know that there are three types of federal accounting. You have budgetary accounting, proprietary accounting, and managerial accounting. Next to the word proprietary, you need to write the word financial accounting because those two words are interchangeable in the study guide, proprietary/financial accounting. So budgetary accounting, proprietary/financial accounting, and managerial cost accounting. And so we're going to look a little bit on each one of those. On page 337, it tells you that there are three types of federal financial statement. So just like a civilian organization has financial statements that the accountant puts together, in the accounting section of the federal government, we also have financial statements that are published. We have the balance sheet, statement of net cost, statement of change in net position. So of the two, you're going to have to be able to calculate a balance sheet and a statement of net cost from this section. The statement of change in net position is just annotating where we are today and now where we are in the future type of thing. So the net cost is you won't be required to do any calculation. You have several examples. You have on page 8, you have a copy of a balance sheet. Page 9, the statement of net cost, and page 10, the statement of change in net position. So as we go through the rest of this section, what you're going to learn is the formula in what numbers you're going to have to pull. If you get a list of factors and data, you're going to have to pull out certain numbers to calculate the balance sheet, certain numbers for the statement of net cost. On page 11, 12, and 12, you have the different laws associated with accounting in the federal government. So be familiar with those, just kind of read through those, like the Prompt Payment Act, we know to pay the bill so you don't get charged interest and so forth. So you read through those. On page 3.3.13, it goes into different agencies involved in the accounting process. These you should be familiar with because they come up throughout, meaning the OMB, Office of Management and Budget, which is the Resource Management Office for the executive branch or the president, Chief Financial Officer. You have the GAO. You have to figure out, okay, well, why is GAO important in the accounting process? The GAO is an independent auditing agency that works directly for Congress. Congress tells us the do's and don'ts of the appropriation, then the GAO is our checks and balances to make sure we honor what Congress has already stated in the appropriations. So GAO, Government Accountability Office, the leader of the GAO, the title is Comptroller General, CG, not Commanding General, so don't get tricked into picking Commanding General. It's Comptroller General. Department of the Treasury, that's the nation's bank. That's where we get our funding from. That's why Article 1, Section 9, Clause 7 says no money can be drawn from the Treasury unless we receive the appropriation law. And you know that once Congress appropriates the money, OMB goes through the apportionment process and the Treasury Department issues the Treasury warrant or the appropriation warrant. When you're studying, don't just study what's on the page, because if you notice, I'm talking about a lot of things that's not directly on page 3.3.13, but you're going to have to recap the things you already know about that topic to tie it all in together. Federal Accounting Standards Advisory Board. So specific to accounting, you have the Federal Accounting Standards Advisory Board. Some additional accounting boards are listed on page 14. Financial Accounting Standards Board, Government Accounting Standards Board, Federal Accounting Standards Advisory Board. So you listed there. All right, so we already talked about all of those key players, those 3 players on page 15, so I'm not doing that again. Then you have some statement of federal financial accounting concepts starting on page 16 and 17. And then those are concepts. And then on page 18, 19, you have statements of federal financial accounting standards. So meaning that's where you can find information. Let's say you want statement number 1 talks about assets and liabilities in that regulation. So that's where you will go to find out about assets, liabilities, and so forth. So hierarchy, DOD, so a lot of information. This is more information. So what I'm going to be doing is flipping to the point where, let's go to page 22 again, DOD policy, because don't forget each level is a DOD exam, so you at least need to know what DOD policy governs the accounting. Well, you have the DOD 7000.14R on page 22. And if you scroll down, you see volume 4 deals with accounting policy and procedures. So for each section, take it down to the DOD policy associated with it. Gives you types of government funds and listed on the bottom of page 22 and 23. So be familiar. Whenever you have a list of items, know the definition so that if the definition is separated from the words, then you're able to put those definitions and words together. Page 24 are some additional types of government funds. You have appropriated, reimbursable, revolving. So every appropriation that we deal with fall into one of those categories, either on page 24 or 25. They're either annual, multi-year, or no-year permanent appropriations. They're reimbursable, they're appropriated, they're non-appropriated, they're NAF funds. So those terms you should already be familiar with from previous sections. Flow of funds on page 26. So remember we talked about when Congress appropriates the money, 2 things happen. Appropriate the funding. OMB goes through the apportionment process, and the legal part is the issuance of the Treasury warrant. That's the notification that the law is in place, the bank accounts have been set up. That happens at the Treasury. On the OMB side, OMB begins apportionment. So Congress appropriates, OMB apportions, and issues apportionment to DOD, Department of Defense, Department of State gets an apportionment, and then those agencies issues allotments to the subordinate organization. And then with the allotments on page 326, then we commit, we obligate, and then we outlay funds. The term disbursement is not used frequently in these CDFM study guides. So you need to be familiar with the word outlay. Outlay, simple definition, is when the funds are removed from the Treasury to pay for an obligation. That is called outlay. So be familiar with that term. On page 26 is the chart, and then the word outlay itself is explained on page 28. Now on the bottom of 28, that chart, you need to know that chart in and out, ins and outs of that chart. So the account number, the title, and the normal balance. Why, you say? Because when you learn the formulas, then you'll see that it's easier to remember the formulas by remembering the order of the accounts. So if you notice, the account numbers goes 1,000 to 8,000. That should make it easy. 1,000, 2,000, 3,000, all the way to 8,000. They have assets, liabilities, net position, budgetary, revenues and financing, expenses, gains and losses, and memorandum. Now let's go to page 29. So the first formula you need to learn is on page 29, budgetary accounting. Remember, 3 types of accounting: budgetary accounting, proprietary/financial, and managerial cost accounting. So the formula you need to learn for budgetary accounting is resources equal status of resources. So you will most likely get a list of account numbers, 1010, 4010, start with a number. So based on the number that account starts will tell you, okay, is that an asset? Is that a liability? Is that an expense? So that's what the chart on page 28 will come in familiar with. So we'll go down. So assets, let's look at, I'm back on the bottom of page 28. Assets have a normal balance of a debit, liability, credit, net position, credit, budgetary is both, revenues and financing sources, credit, expenses, debit, gains and losses, both, and a memorandum, not applicable. So that's easy to remember. So what you do is you look at the normal balance. What are the same? You have two debits. Assets and expenses are debit, normally debits. The rest are credits, and then you have two both, budgetary and gains and losses. Budgetary starts with a B, both. So budgetary and gains and losses are typically both, and everything else is credit. All the other three credit, so that should make it easier. All right, so resources equal status of resources. All right, on page 30, those two formulas you will have to memorize. When you take these types of exam, they do not give you the formula, they do not provide it. They might say, out of all of these accounts, ranging from 1,000 numbers to 8,000 numbers, calculate the balance sheet. And remember, a balance sheet, basic accounting, one side of the T ledger must equal the other side. So the formula for the balance sheet on page 30 says assets equal liability plus net position. So that means if you pull out all your assets, pull out all your liabilities and net position, then when you total all your assets will total liability plus net position. Now go back to the accounts. Remember, assets is your 1,000 number. So when you get a list, anything that starts with a 1, you pull all those numbers out. Those represent all your assets. When you get your list, liabilities is equal. Liabilities are all your 2,000 numbers. Everything that starts with a 2,000. You pull all those values in, and then you add everything that starts with a 3. 3,000 numbers is net position. So the formula to calculate a balance sheet is assets equal liability plus net position. And if you flip back to page 28, again, title, assets is 1,000, liabilities 2,000, net position 3,000. Now you know that. Debit, credit, credit. Debit, credit, credit. Debit, credit, credit. Debit, credit, credit. Assets equal liability plus net position. Assets equal liability plus net position. Debit, credit, credit. Budgetary. Remember we said anything that starts, so I'm flipping back now to page 29. Budgetary is everything that starts with a 4. Whatever that value is in that list of things, everything that starts with a 4 is either a resource or a status of resource, and it'll tell you that in the list. So anything that starts with a 4 is budgetary. Budgetary normal balance is both, right? Budgetary B, both, B. That's easy to remember. So debit, credit, credit, both. Debit, credit, credit, both. Assets equal liability plus net position, and 4,000 is my budgetary. So I'm back on page 30. All right, I'll slow down for a little bit. So that was my balance sheet. So 3 federal statements, recapping. Balance sheet, statement of net cost, statement of change in net position. So I already told you, you're not going to have to do anything with a statement of change in net position. You're going to have to do your budgetary, resources equal status of resources, balance sheet, assets equal liability plus net position, and now your statement of net cost is your expenses equal revenue. Let me say that. Expenses minus revenue equal net cost. I was like, huh? Expenses minus. So go back to your list. So remember, expenses is your 6,000 number. So if I'm minusing, if you look at it, the higher number is 6,000 minus 5,000, which is your revenues and financing sources. So my debit minus my credit will give me my net cost of operations. 6,000 numbers minus 5,000 numbers equal net cost. The next few pages now will show you in the accounting ledger what type of transaction each flow of funds requires. Congress appropriates the funds on page 31, transaction number 1. It says that it requires a budgetary and a proprietary. Now, I'm not going to tell you to sit there and memorize the account number 4119, account number 4450. Don't waste your time doing that, because I doubt they'll go that deep. But know that in transaction 1, once Congress appropriates the funds, then it requires a budgetary and a proprietary transaction. Transaction number 2, OMB apportionment. So let's go back to transaction 1. So remember, I said 2 things happen when Congress appropriates. The first legal part, once they appropriate, is a budgetary action, but the proprietary piece is the fund balance at the Treasury. When the Treasury gets involved issuing the Treasury warrant, that's your proprietary entry. That's where we get ready to spend the money. Budgetary is more of the documentation. Proprietary is more of the actual spending. That's what I noticed, financial, to tell the difference. Transaction number 2, OMB apportionment, the SF-132 process. It only requires a budgetary transaction, right? Paperwork. That's as deep as I go into these, and I recommend for you the same. So OMB apportions, DOD issues allotment. So transaction number 3, the allotment, only requires a budgetary transaction. We're not really spending, we're just passing the money down, paperwork, passing it down. So when you pass it down, it's just a budgetary transaction. Transaction 4, commitment of funds. I haven't spent it yet, so it only requires a budgetary transaction. The top of page 32, transaction number 5, obligation of funds. You have only a budgetary entry. It's like, my budgetary. Okay, so obligation of funds, I haven't spent it yet, requires a budgetary entry. So once I have ordered or placed the contract and I receive the items, now it requires 1 budgetary and 3 proprietary, but it requires both a budgetary entry and proprietary entries. And then the final step, number 7, I'm paying the invoice. The invoice then requires both a budgetary and a proprietary entry or financial entry. So if you notice, it was transaction 1 that required both, transaction 6 and transaction 7. Everything else was budgetary. So make sure you review that section to get comfortable with it. All right, so they give you more examples of general ledger in 34, trial balance. You notice your debits and your credits are in different size and based on their normal values, but either way, both the debits and the credits must be equal. Another example of a balance sheet and a statement of budgetary resources. So anytime you hear budgetary, the numbers all got to start with a 4, right? Page 36. Fund balance at the Treasury, they give you the definitions of those other terms, accounts receivable and so forth. So I'll let you read through those. Fixed asset, tangible. All right, so what I need to go to now is managerial. So a lot of these is just repetitive. I want to go to page 46, which is managerial cost accounting. So as a manager, as a leader of a section or organization, it requires us to track what does it cost to operate this business? What is the overall? What's the direct cost, the indirect cost, the admin cost, and so forth. So that's what this involves. So it references on page 46, that second paragraph gives you the definition of managerial costs. And remember when I went through in the beginning, those standard, the accounting standards on those charts? So number 4 is where you will go to get the definition for managerial cost accounting, but it's given to you here. So that's what that's referencing. All right, so managers 47 have 2 types of ratio analysis that we do. The current ratio is used to determine, can we pay our bills? Can we meet our obligation? That is what, when you get a value from the current ratio, a value of 1 or better is actually good. Because what that means is, one, if you have a current ratio of 1, it means we're breaking even. The money I'm taking in is what I'm paying my bills. Cash, accounts receivable plus inventory divided by what I owe, my current liability. If I want to say I earn a profit, then the current ratio of 2 to 1 is better, as listed on the second paragraph on the current ratio. The other one is the quick ratio. Sometimes we need data back quickly. We don't have time to do an inventory of the assets that we have. We just know how much cash we have, how much accounts receivable. Can we pay our bills? Solvency. How quickly can not just pay our bills for the current ratio, quick ratio, if we have to go out of business, how quickly can we sell off these items? So inventory is not included in the asset test ratio or the quick ratio. That's another term that's used for the quick ratio. So a test of, immediate solvency is made by comparing the sum of cash and accounts receivable divided by your current liabilities. So although not applicable to appropriated fund, both of these ratios are used in the working capital fund as they conduct business type operation. So even though you may not use them because you use MDEPs and you use appropriations, if you are part of the working capital fund, that they are that revolving account, then they have to do these type of ratios. So I want to make sure I point that out there. All right, some good example on page 49 for these exercises. I don't normally point out the exercises, but this one is good because it actually trains you to recognize the account numbers. And then the first question says, is it a proprietary or budgetary entry? And remember, budgetary number starts with 4. So for instance, the first one is 4119 on page 3349. Then that'll say column A is a budgetary entry. And then the only other budgetary is number 11. Everything else is a proprietary/financial entry. Then column B says, note if the account is an asset, a liability, or a net position. So remember, 1,000, 2,000, 3,000. If the number starts with those, then you determine whether they're a liability, asset, or net position. So you can do that there. The third requirement is to show the normal balance, debit, credit. So remember, it's debit, credit, both. And then you have your assets. Let me see if I can do it. Assets, liabilities, net position, budgetary. 5,000 is revenue, 6,000 is expenses. What am I missing? Memorandum. Okay, hold up. I got to go back. Because that's why I say you got to memorize page 28. Gains and losses. Okay. Assets, liabilities, net position, budgetary, revenues, expenses, gains and losses, memoranda. All right. So debits are assets and expenses. Both is budgetary, gains and losses. And then everything, memorandum is not applicable and everything else is credit. So if once you recreate the chart, I would advise that you recreate the chart before you start taking the test when you get ready to take module 3, and go ahead and put them in their right places. And then whatever question comes, then you already have your chart recreated. All right, looks like this is the end of the accounting section of CDFM Module 3, Competency 3, Accounting, out of the 2020 Study Guide. So be sure to click like, click share, and share this YouTube video for those that are studying to become CDFM certified. This is Helen Thomas and the CDFM Study Group, and I'll see you guys again next time.